Joining us with more is Andrew Keys. He's the co-founder and president of DARMA Capital. Andrew, does all this talk about ETH potentially being a security make you nervous at all?
I don't think it makes me nervous. I think when understanding what the SEC explained, they took specific issue with how Kraken was using their program for staking as a service. When you dig into the details, there were two pieces that I found specifically compelling. One was that the SEC took issue with the commingling of assets, and the other was that rather than a technology service provider that charged a percentage of a validator's return, for example, if an Ethereum validator generated 10 Ether, you could have a 10% fee. And basically 9 Ether would go to the client, 1% would go to the technology service provider. They didn't publish the way that the staking yields were processed. So Chairman Gensler used the example that Kraken could have potentially traded to generate yield, or lent to generate yield, or staked to generate yield. So I think there was specific nuance that should be considered with respect to understanding really what the issues that were taken.
Yeah, and just to remind viewers, Kraken paid a $30 million fine to the SEC as a settlement, and they're discontinuing its crypto staking services for U.S. customers. What are some of the lessons learned from that case then?
So I think the lessons learned are to potentially have non-custodial staking with assets that are not commingled, and that staking vendors really need to operate as service providers, not entities that are essentially offering a certain amount of yield that you would see in an investment contract.
So you don't see it as a problem. Do you think it'll benefit you in any way by having the SEC crack down on the likes of Kraken?
Yeah, I think basically this gives regulatory guidance, and I don't think regulatory guidance and clarity by enforcement is the right way to go. I second Pierce's dissent.
Boring. Okay, sorry.
Yeah, Pierce's dissent, where she said that we should have had ways to give regulatory clarity, but now we at least know the rules of the game and what the SEC was taking issue with.
So you're trying to build the largest staking pool. Tell us a bit about that and how you feel users could benefit from this.
So I don't necessarily have the plan to build the largest staking pool in the world. We do manage over 10,000 Ethereum validators, and we believe that Ethereum has proven that blockchains can form consensus without the overconsumption of electricity, as in Bitcoin's proof of work, which we think is extremely important. Furthermore, the ability to generate yield without the need to rehypothecate, like what's happened in Celsius or BlockFi with their lending programs, we find very compelling. And lastly, as a network, we think Ethereum has proven to become deflationary through what's called the EIP 1559, which is a method of burning Ether per transaction. So in terms of kind of the institutional investor outlook, we think that this is probably the most compelling asset in terms of risk-adjusted returns. We still believe there's probably a 10 to 50x in Ethereum over the next 5 to 10 years. And now that one can be ESG friendly, generate yield on the asset, so you can essentially earn more of it by being long and contributing to beneficial actions within the network, and having this deflationary policy within the ecosystem is compelling.
So we also see the Shanghai hard fork in Ethereum's future. What are some of the impacts that could have on your staking pool? The biggest pros and cons of the upgrade.
Sure. So big picture, Shanghai is scheduled to occur in late March or early April. And what this does, it enables Ethereum staking withdrawals. So essentially, we've had a one-way street where participants could stake their Ether, earn the yield, but weren't able to access that yield or the principal Ether. Now, we'll be able to have withdrawals. So big picture, I actually think short term, this could be bearish as people access liquidity. But long term, I definitely believe this to be bullish. As now there's the ability to withdraw, we believe that more will actually stake. Currently, there's about 15% of all Ether. That's about $29 billion of total market cap that's being staked. And I could easily see that number going to 30 to 40% over the next 24 months. And lastly, I think once this upgrade is done, we're getting to the really interesting scalability upgrades. So proof of stake kind of set the stage for what's called dank sharding, where Ethereum can have shards of the network form consensus rather than having the entire network form consensus. So getting this kind of logistical upgrade out of the way sets the stage for a really important scalability upgrade, which is kind of what Ethereum has really promised and has researched over the last 5-7 years.
And am I correct in saying that you put all your chips in on Ethereum? And how does that value proposition prove more beneficial than, say, what's going on in the traditional financial system with the Fed and managing bonds, et cetera, and inflation?
So I haven't put all my chips in Ethereum. I do have some diversification, but it would be fair to say I have a majority of my chips on Ethereum because I believe this is the substrate for the next generation of the global economy. And I think that this commodity of Ether and the block space that it represents will continue to be one of the most important assets going forward over the next decade. That being said, obviously with interest rates rising, there is yield to generate from T-bills, but I think that we have an opportunity to re-architect the way our social, economic, and political operating systems work, and I want to contribute to that.
Andrew, thank you so much. That was DARMA Capital Managing Partner Andrew Keys, and Andrew will be joining us at Consensus 23 in Austin, Texas this April. So be sure to check out the agenda and get your tickets. Head over to consensus.coindesk.com for more.